And we're live. So how you doing, Dave?
Good, Mark. Nice to see you, my friend.
Nice to see you. So this is a special recording of our Wednesday webinar, and this is a recording today because I really wanted to bring you David McKnight. We've been talking for a little while, trying to work out a time, and our schedules were just colliding. So we worked out this time on a Tuesday afternoon, and I said I'll just package that for you all to see it on Wednesday morning. And I'm sure Dave will also be sharing this information as well on his platforms, as he always does. But as we always do, we have a lot to talk about today. So let me just introduce Dave again. So you all know Dave. This is, I think, our 110th video together. Not really, but David McKnight graduated from Brigham Young University with honors in 1997. He has been featured in Forbes, USA Today, the New York Times, Fox Business, Bloomberg Radio, MarketWatch, CBS Radio, CNBC, Yahoo Finance, NASDAQ.com, Reuters, Investors Business Daily, Kiplinger's, and numerous other national publications. David's best-selling book, The Power of Zero, has sold over 400,000 copies, probably more now, and the updated and revised version was published by Penguin Random House in 2018. This book was recently made into the full-length documentary film entitled The Power of Zero, The Tax Train is Coming. When his follow-up book, The Tax-Free Income for Life, launched in November of 2020, it finished the week as the #3 most sold business book in the world. When his most recent book, The Guru Gap, launched in December of 2024, it finished the week at #8 on the USA Today bestseller list and was the top-selling business book in the world. He and his beautiful wife, Felice, have 7 children. And Dave, anything you want to add to that bio?
It was already far too long, so we'll leave it at that.
I went as fast as possible.
Yeah, I know.
So I just want to remind you of the goals for you as listeners, and that's to be inspired to make changes. This channel is about education, not advice. Advice should be very personalized. You do have the opportunity to meet with me directly if you have at least $1 million in your retirement accounts. You can meet with me directly, and there'll be a link where you can schedule that time, or you can reach out to us at questions@attleborowealth.com. That's questions@attleborowealth.com. But the goals I have for you as listeners is to be inspired to make changes. Open your mind to different ideas and different ways of thinking about financial planning and investing. Stay educated so you feel confident in the changes that you've made in your financial plan and the strategies you put in place, and stay updated so you can make adjustments along the way. As always, this is YouTube, so we have to say, Dave, if you haven't already, you have to hit the subscribe, like, and notification buttons, right? But we've got a lot to talk about today. So Dave and I put some things together for you. And one of the first ones is, there's been a lot of changes with the OBBBA, and we want to talk about those. So Dave, what are you seeing out there? I did a video with talking about OBBA changes in the beginning, and then I just did another one last week. But there are some big effects as they apply to Roth conversion. So let's talk about that. So has the OBBBA wiped out the possibility for effective Roth conversions, in your opinion?
The OBBBA did a couple of things, the most interesting of which I thought was not just an extension of the Trump tax cuts from 2017, but a permanent extension. And we all know that the IRS tax code is temporary by definition. It's sort of written in pencil. But they're telling us that it's a permanent tax cut. And, we had always planned on tax rates reverting back to what they were in 2017, starting January 1st, 2026, because that was the expiration. Anytime you do something through budget reconciliation and you can't demonstrate that over a 10-year window that it's not going to substantially increase the debt, then you have to do it through budget reconciliation, which means it has an expiration date of 8 years. It sunsets. So everybody knew that an extension of the Trump tax cuts for another 8 years would not be a cost-free proposition. And so everybody's just understood that it would only be another 8-year extension. But the Republicans, through a little bit of accounting legerdemain, were able to make the case that the TCJA was the new baseline. It was the new sort of law of the land, and it didn't have any inherent cost to it. So an extension of that would not incur any additional cost. So that was the case that they made, and somehow that made it through, even though it's going to cost between $3 and $5 trillion to extend those tax cuts over the next 10 years. So we now know through this new One Big Beautiful Bill Act that tax rates are permanently extended, and I'm calling that the temporary permanent extension of the Trump tax cuts, which means that we now have, I'm predicting, Mark, that we're going to have another 10 years of these historically low tax rates or near historically low tax rates. So for people who are interested in doing things like Roth conversions and want to have some degree of certainty as it relates to their tax bracket when they execute those Roth conversions, I think you're going to have about next 10 years. And the reason I'm saying 10 years or until 2035, saying through tax year 2034, is because when we hit 2035, the debt to GDP is going to be about 150%. That gets us a little bit into the danger zone. I mean, we're already in the danger zone, but we're really starting to get into a window where we have to start acting before it gets too late. We're going to be at 175% debt to GDP by 2040 and 200% by 2043. And the reason I'm telling you those numbers, Mark, is because Penn Wharton recently came out with a study in which they say that if we don't right our fiscal ship of state by 2043, best case scenario, no combination of raising taxes or reducing spending will sort of arrest the financial collapse of our nation. But they say, worst case scenario, that could happen as soon as 2040 when we hit 175% debt to GDP. So when we hit 2035, we could, in theory, have only 5 years to act to get our house in order, raise more revenue before we start defaulting on our debt or have to start to really do drastic things to prevent us from defaulting on the debt. So I see that no politician wants to get voted out of office before they absolutely have to. So they're going to continue to kick the can down the road on the fix. So I don't see anything changing until 2035. You can make the case, hey, power changes hands in the meantime. If you're in the 22 or 24% current tax bracket, I don't see that changing your tax bracket. Democrats have always campaigned on this idea that if you make 400,000 or less, they're not going to change your tax bracket. They're not going to give you a tax increase. So I think even if power changes hands over the course of that 10-year time period, I don't think we're going to see an increase on tax rates for Main Street America. And then, of course, you and I have talked about this, Mark, extensively. One of the things that came out of the One Big Beautiful Bill Act was people thought that it eliminated tax on Social Security, that somehow fiddled with the provisional income thresholds, or that which is the income that the IRS tracks to determine if they're going to tax your Social Security. That's not really what happened. What happened was they increased slightly the standard deduction from $30,000 to $31,500, and then they basically gave, if you're 65 or older, they gave you a special senior deduction that lasts for 4 years, 2025 through 2028. $6,000 if you're single, $12,000 if you're married. And the net effect of that is that a lot fewer people will end up paying taxes on their Social Security, but it doesn't change the fact that provisional income is still sort of the law of the land, and they will be measuring your provisional income, and you just don't buy into the narrative that Social Security taxes is necessarily going away. And of course, it's going to come roaring back in 2029. So those are the two big changes. There's obviously a lot that went into the bill, but those are the two big changes I saw on my end. What did you see on your end? What struck you?
Well, I tell you what strikes me with every piece of legislation is you think things are complicated now until the next piece of legislation. So I remember when I first started in this industry, we had to worry about two ages, basically, 59 and a half and 70 and a half. We were talking about now there were a whole other basket of ages you had to worry about with Social Security planning. But now we have to worry about 59 and a half, and we have to worry about 70 and a half for QCDs, 73 for RMDs unless you're born after 1960, and then it's 75. And then if you're, to trigger the bonus senior deduction or senior bonus tax deduction, you got to be over 65, but that's only for 4 tax years, right? So we have all these dates swimming in our head, and let's not forget the super catch up. The super catch up on your retirement plans that makes no sense at all, right? these are the things I take away from the one big beautiful bill and all legislation, is that it just makes our jobs much, much more complicated. And I always say to people that when we bring a recommendation to someone, we prove it out first in the financial plan. And it's not, I wish there was a planning portal that just allowed us to input the numbers and it calculates like this. And somebody in class said, just use GPT. But I did a class, a presentation for our local college here when my daughter was attending there for the honors program. They wanted me to present about some financial basics for college students, and I had fun playing with the AI platforms. But some of the math was wrong. So I wouldn't put my tax strategy in the hands of AI at this point. It can be a good assistant, but it's not the end all be all. But I don't know how an individual does it by themselves at all, when it takes a team of experts sitting here in my office, including certified financial planners, chartered financial analysts, and CPA, and and also a team of experts from your group and the Slott group, and to be able to put all these things together. So what I take away from it is just unnecessary difficulty and frustration. And someone in my position could say job security, but I think things just need to be simplified for the American people a lot better. There is a bill. I don't know if you saw, but I don't know the person's name, but a Democrat congressperson who proposed to eliminate Social Security tax altogether. So that's unfortunately that's not sustainable, right? Because the tax goes to fund the trust fund, but boy, the adjustment, some inflation adjustment on the provisional income brackets would be really nice for folks, because I think
one number you don't have to learn, you just memorize it and you're good to go for the next 10 years, right?
Yeah, since what,
It's one number that doesn't
1983,
change.
right? Yeah. I always
You and I were talking earlier about what the OBBBA and that special senior deduction means for people who are contemplating Roth conversions. And it is a complicating factor because, you've got these phase outs. If you're single, the phase out starts at $75,000 until you hit 175. Every dollar you're over that threshold, you lose 6 cents of the deduction. And if you're married, it goes from 150 to 250. And so what's going to happen is if people don't account for that and they do Roth conversions as if it were 2024, for example, they may end up phasing out of that deduction. And so that's just yet another expense that people have to think about, along with IRMA surcharges and Social Security taxation and phasing out of ACA, subsidies and all of these different things, the additional taxes that you're going to have to pay. So you really have yet another variable that you have to think about when doing a Roth conversion. Because think about it, if you're not 30%, including state marginal tax bracket, and you forego that deduction by doing a Roth conversion that pushes you beyond the threshold, now all of a sudden you're out $4,000. So it's an additional $4,000 of tax you'd have to pay that you wouldn't have otherwise had to pay. So it's a complicating factor, and it just means you got to take a look at the calculation that much more closely before you just got to look before you leap, right?
Yeah. And I remember a person that came up to me during a class last year, so before more confusion, and he was very proud of himself, talking about, and he had the tax form, or the tax planning sheet that I hand out in class that has the tax brackets, and he was very proud of himself for telling me how he had figured out the amount up to the 24% bracket. He had done a couple of years of conversions, and I said, not to take the wind out of his sails, I was happy for him, but I said, I asked him how old he was, and he was 63. And I said, you're considering IRMA, right? And he said, what? So IRMA is income related monthly adjustment amounts. These are the additional amounts that you pay for your Medicare. It's a surcharge, which can be significant. And it's another tax. It's another tax is what it is. And it surprises you because it has a 2-year look back. So these, again, these are all the things you have to consider.
I sort of wonder what Ed Slott would say. I think I can guess based on some past statements that he's made. He doesn't really care about IRMA. He says, I take the rip the Band-Aid off approach to Roth conversions. He's just so so high on Roth conversions, as am I, and as are you, that he just says, look, you're gonna, yeah, who cares if it's a trade-off? You pay a little bit more in the here and now in exchange for never having to worry about those, paying, higher taxes down the road in terms of Social Security taxation or busting through new IRMA thresholds or higher taxes. He says, rip the Band-Aid off, get the heavy lifting done, and then spend the rest of your own life enjoying a low or no tax rate environment. But it would be interesting to see if he still feels that way, given the $4,000 of tax savings that you would forego by doing a Roth conversion that pushed you past those phase out thresholds.
Well, I'll let you know in November because I'm going to spend a day and a half, 2 days with Ed at our semi-annual updates. But one of my favorite lines recently that I've picked up from Ed is, with doing Roth conversions or even transferring money to cash value life insurance, you're locking in your tax rate for your lifetime plus 10 years. And when you think of it that way, it really helps. It helps simplify things. But the thing is that it's easy for us, David McKnight, Mark Byelich, Ed Slott, because we live in this every day. We know taxes are going to go up. The question is just when, and we have a pretty good idea about that. And we're convinced that that's going to be the case. But your average individual reads your book, The Power of Zero, attends one of our courses, maybe reads Ed's book or sees something, and they're really excited. They understand it in that moment about doing Roth conversions, and then they go back to their everyday life, and they talk to their brother, cousin, plumber, friend who says,
right.
Why would you do that? Or sometimes CPA, not as much now today, but sometimes, certainly in the past, it was their CPA who would say, don't pay taxes before you have to. We don't know what the future of taxes are going to be, but the math is on our side, Dave. And but our job, my job, I think, is, when I'm talking to my team about client reviews, most financial advisors use a review of look how well we did in our investments. Well, that's important. Let's just see how the investments did, and let's see if we have to make changes. But it's also, I say, this is about reviewing and reminding people why we're doing this, showing them that what drove them here in the first place, the potential savings or additional growth they're going to have in these strategies. So it's hard. It's hard for your everyday person, and these misinformation. You've got a lot of experts out there on YouTube who are saying the wrong things about Social Security taxation. You had the Social Security office themselves issue an erroneous report about Social Security tax. There is nothing in that bill that reduces or eliminates tax on Social Security. It could reduce or eliminate your overall tax bill, but it's not directly aligned with Social Security. And our own Social Security Administration certainly made it sound that way.
Right, that was a really confusing letter that came out. They basically said, thank you, President Trump, for passing this bill that eliminates Social Security taxation for 90% of Americans. And that's not, like you rightly point out, that's not what the bill actually said. The bill says we're going to massively increase your deductions. One sort of benefit of which will be that fewer people end up paying tax on their Social Security. But that's not explicitly what the bill did. And so a lot of people came to us saying, hey, look, did they eliminate the provisional income thresholds, what have you? And so there was a lot of confusion around that. And we've had extensive discussions on what really happened was you increased your deductions. And so if you had a taxable portion of your Social Security, then that was in many cases getting washed out by that additional level of deductions that everybody got.
Yeah. Well, it'll continue to be challenging. So, recently there was an executive order that came out of Washington with some changes to retirement plans, 401k, 403b plans, et cetera. So do you want to talk about that a little bit, Dave?
Sure. Yeah. I mean, historically, when you look at the menu for your 401k investment options, you basically had three things. You had stock funds, bond funds, and cash. Those are three options. And basically, what this executive order did was it expanded the menu of options that people are going to have. And I've got my opinion on whether this is a net positive or negative for America. But basically, you're going to get some of these more complex investment alternatives as part of the menu in your 401k. What are we talking about? We're talking about crypto. Crypto could now show up on your 401k menu. You may be able to invest in Bitcoin as part of your 401k plan. Some private equity and venture capital, those types of things are showing up, and some real estate projects and funds, those types of things are also going to be showing up on your portfolio. So this is to the extent that it expands the choice. I think that's a net positive for America, for people who understand the complexity behind some of these new alternatives. I think that more choice is better. Expanded choice is a net positive. I do worry about some people who look at these new options and they look before they don't look before they leap. They don't read the fine print. They don't understand, for example, that these are much more complex offerings, that maybe they have higher fees. Maybe you won't know what the return on your investment will be right away. It might take a whole year before you understand the return of your investment. They may be inherently illiquid. So there's all these different considerations that people need to take into account when evaluating whether or not they should invest in these new alternatives. So I think that like you said, Mark, our jobs are safe with these new alternatives requires new levels of education in terms of where people should be ultimately investing their money.
Yeah, that's for sure. Because, if you think about your average investor, again, when you look at 401k plans, they're usually not managed well. They're not chosen well. Sometimes they're the same investments they chose 25 years ago when they first started, if they're with the same company, or somebody in the office guided them towards them. So there's not a good process. Even 401k providers are limited in the advice that they can give. They really can't give advice unless it's a different agreement. But thankfully, with us being in the RIA space, registered investment advisors, we're able to help people with their company plans if we have an agreement to do that. And more of that's going to be needed, because as you said, access is good. Having alternatives other than stocks, bonds, and cash can be a good thing. But people get caught up in the excitement of things like crypto, or like private equity and private debt. A big movement right now that I hear a lot is you want to invest in your favorite sports teams. You can do that now through private equity and private debt. So that can be, we were talking about baseball cards, right? So that could be exciting if suddenly I could own a piece of the Phillies through my 401k. Yeah. So that's right. So that can be great for an individual, but it has to be done cautiously. And I would like to see if I could draft two pieces of legislation or executive orders, if I had the power of the pen, other than world peace, right? I would do a couple things, and that's require require advice on 401k plans. And I think you would see better results for individuals, and also allow for Roth conversions to be done before the tax filing deadline, for crying out loud. Wouldn't that make things easier? So instead of on 12/31. And then, of course, we talked about it, increasing the provisional income brackets, adjusting it for inflation, because, as we said, 1983, I think, was the last time that was adjusted. So
when you think about the 401k menu of alternatives, what do most people default to? They default to these target date funds. Yeah, I'm going to retire in 2040, therefore I'm going to put all my money in there, and it slowly changes the ratio of stocks to bonds year by year as you go along, and it's sort of set and forget it. So you go from this like hands off. I don't really understand it. I just know when I'm going to retire. You guys take care of the rest. It's like the most simplified approach you could possibly imagine to adding crypto. I mean, the pendulum is swinging all the way the other way to these really complex alternatives, and most people don't know. I'm not going to say most people. Some people don't know a stock from a bond. They don't understand how to analyze investments and how to gauge the amount of risk they should be taking in their portfolio at any given point in their lives. And now we're expecting them to understand the difference between private debt and private equity, and Ethereum and Bitcoin and things like that. So I think there'll be an interesting phase. I'd like the expanded selection. I just think there's going to need to be a lot more education around these menu alternatives.
Yeah, absolutely. So we were talking about some things for the broadcast today, and one of the things that you talked about was somebody asked you, during an event. What are some of the biggest retirement mistakes you see? So we kind of drafted out, well, 5 or 6 of them. So would you like to go through those?
Yeah, I was playing golf with my son in you know where I was, Mark? I was in Jekyll Island, Georgia,
Oh yeah, nice.
home of the Federal Reserve. They wrote a book called The Creature from Jekyll Island, because that's where the idea of the Federal Reserve was conceived by, J.P. Morgan and Rockefeller back in the day. I was on a golf course in Jekyll Island with my 12-year-old son. We were playing, and we got paired up with a couple of one was late 60s, other early 70s. They asked what I did for a living. I said I talk about retirement, I write books on retirement, those types of things. And so they got around to ask me, I said, well, what is the single biggest retirement mistake that you see? Given that you converse with so many different people about their retirement situations. And so I had to think about it a second, but I mean, a lot of risks and mistakes came to mind. But I think the one that I obviously talk about a lot is just not being prepared to navigate your tax situation in retirement. We sort of have been putting money into the tax deferred retirement accounts our entire lives. We've been told that getting a deduction at historically low tax rates was a good idea, only to postpone the payment of those taxes till a point in the future when tax rates could be much higher than they are today. So we've been weaned on that idea historically, and we get into retirement and we realize, hey, that may not necessarily be the case. We may, in theory, given the debt trajectory of our nation, we could be in a higher tax situation when we withdraw those dollars than we were when we made the contribution. And so I think not thinking through that entire process, I think that in some people's cases, it's a very clear-cut decision. When they have the knowledge and the education based on where tax rates are headed and their own personal situation, they opt to execute a Roth conversion. But a lot of people aren't getting that type of advice. They just have been told to defer, defer, defer. And then when they come to retirement, they simply take withdrawals or postpone withdrawals until the IRS forces them to take distributions. And the tax situation is what it is. They get what they get and they don't pitch a fit, right? As I tell my kids. So they're just, they're as Ed Slott calls it, they're on the government plan, and they need a plan that shields themselves potentially from the impact of higher taxes down the road. So I think that was probably my first choice. You and I talked about a bunch of other things. Tell me what you said earlier. What's at the top of your list? I thought that was really interesting.
Well, my number one was, and I did a video about this. The number one retirement planning mistake is not knowing your expenses. And there's a couple reasons for that. Is that people lowball it. They even folks. I was saying to Dave that, engineers find us. We have a lot of clients as engineers, so we'll have people come in with just years of data, and that's great with their expenses. But there's often things that they're missing, and pet expenses, hair and nails, things like that, things that can add up. And so you really have to do the work. You really have to shake the trees to identify those expenses, and then and then you have people who aren't that detailed, and they just say, well, $10,000 a month or $12,000 a month. They're just kind of spitballing it. And then advisors are complicit in this as well, because a lot of times financial advisors, when I talk to other financial advisors around the country, and we talk about financial planning tactics, I ask them this question: how do you identify expenses? And they'll say, well, the people tell me if it's $12,000 a month, I put that into my financial planning program. But what if it's $15,000 a month or $16,000 a month? And if you don't do the work, you have this huge deficit you're starting at, and either the people don't get to have the type of retirement that they deserve, or they should have, or you've got a risk of running out of funds. And there's a lot of things that I see that people aren't considering with these financial plans. And I use kind of financial plans loosely, but it'll be all rosy for them. It's kind of like looking at the rose-colored glasses, and then I say things like, "What about higher taxes? Have you tested for higher taxes?" Well, no, we haven't considered that. And every large financial institution won't even allow their advisors to talk about taxes. They have disclaimers on their websites and statements that say, "We do not give tax advice. One of the biggest expenses during your lifetime," and they just say, "We're not even going to talk about this." It's crazy if you think about it. So, but that's the big one for me, is not knowing your expenses. And all the other ones are, not considering taxes, of course, is huge. as well.
Yeah, the other thing that you hear a lot, and I'm sure a lot of your listeners have heard this, it's this idea that you're only going to live on 80% of whatever your lifestyle requirements were
Oh,
during your working years, right?
yeah.
And I love a line from Tom Hegna. Tom Hegna says, "Hey, when do you do most of your shopping at Home Depot on Saturday?" He says, "Guess what? When you're retired, every day's a Saturday."
That's right. Yeah.
Which I think is a really good point. You know, you do more traveling than maybe you otherwise would. Maybe you do more golfing than you otherwise would. You're not working. So you're not maybe otherwise engaged. So you're spending more money in other areas. And so I think people just need to account for that. But I think you can account for that by going through the exercise you talked about there.
Yeah, you have to. Yes. And I also, so you write a lot and I'm working on a book, you know that, and hopefully it'll be done. Our target is November, but I'm not optimistic about that right now. But but I have a section about the 4% rule, and I kind of say the 4% rule is bull, with another little tag on it, because the risk of the 4% rule is that first of all, there's market conditions that may not live up to supporting the 4% rule, but on $1 million, 4% is $40,000 pre-tax, and that may limit you on the lifestyle that you might want during retirement. So you might limit yourself in the beginning because the curve is usually, you spend more, it dips down, and then we spend more later during the later years for medical costs. And that big jump in the beginning is, every day is Saturday and you want to travel and there's things you want to do. And if suddenly you're limiting yourself to just a 4% withdrawal, or so the Vanguard came out, they've adjusted it a few times, but I remember reading 3.25, 2.75. The CFP board at one time had published 3.25. These are kind of arbitrary numbers based on expected rates of return instead of individual needs. And in my opinion, your withdrawal strategy should be based on your individual needs, not dismissing the risks involved in that. That should be part of the plan, and then the plan should be reviewed every year. So I think
one thing, pardon me, one thing people forget about the 4% rule is the 4% rule. If that's how you're going to sort of ensure that your money lasts as long as you do, you got to remember the 4% rule is a pretty jealous master. People have a hard time sticking to 4% over 5 years, let alone a 30-year period. You got to remember that if you are going to live by the 4% rule, that means you got $1 million. That first year you can take out 40,000. The second year you can take out 40,000 plus 3%, which is 41,200, and you can continue on that wise for the next 30 years. Well, guess what? What happens if in any of those years you decide to take out 6% or 7%? Drop back down to 4%, go back up to 5%, up to 7, maybe 8, back down to 4. Every year that you violate the 4% rule, the mathematical likelihood that your money will last through life expectancy starts to drop like a rock. And so you have to have the Zen-like precision to be able to, Zen-like discipline to be able to follow the 4% rule. And so it's a jealous master. If you're going to live by the 4% rule, you got to really live by it, or you're not going to have that mathematical assurance that your money is going to last through your actuarial life expectancy.
Yeah. Yeah. So the answer, folks, just so you know, is what I believe is establishing that foundation of asset allocation, principal protection, and account segmentation. So you've all heard me talk about that. And if you want more, if you don't know what I'm talking about, you can. I'll put a link in the description here. But that's really just Dave. I think you call it time-based investing. But the account segmentation is something we're adjusting all the time, and what we're seeing actually right now is increasing we have a lot of our segments we're putting out to later in life because we assume for our like cash now segment, usually the first 3 years, our stated objective is 2%. So obviously we've been getting close to 4.5%, 5%. So we've got these segments that are overfunded, and which is a great thing because now we can send them off for growth components later in life. But you can't do these things in a vacuum. You can't do it based on the 4% rule or the 3% rule, or if you're Dave Ramsey, the 8% rule, or 13%. Didn't he throw a 13 out there at one point?
I'm sure he has at some point. I don't know.
But it's it's based on your investment decisions should be based on your financial plan. Your financial plan should be comprehensive. There should be a comprehensive process for it. It's not just a the tag word or a keyword, a comprehensive financial planning, and it should be done every single year. You should go through it every single year. So we also talked about, another thing we talked about was longevity risk. So that rolls right into this conversation.
Yeah, I mean, longevity risk, according to Tom Hegna, who is one of the leading, he's one of the brightest stars in the retirement planning constellation in our industry. He's he's been one of the leading advocates for using guaranteed lifetime income as the most cost efficient way to sort of mitigate longevity risk and sort of purge it from your retirement picture. The thing that's sticky about longevity risk, and longevity risk is basically the risk that you'll outlive your money, right? That's that you'll live too long and die broke. The issue with longevity risk is it's what we call a risk magnifier or a risk amplifier. The longer you live, the more likely you will succumb to an array of other risks that, if not addressed, will sort of send you to the poorhouse 10, 15, even 20 years prior to when you had ever anticipated. So, these are things like sequence of return risk, withdrawal rate risk, inflation risk, long-term care risk. If you really do a deep dive on each one of those risks, you'll see that the longer you live, you either amplify the likelihood of succumbing to one of those risks, or you amplify the consequences of succumbing to those risks. And so, so the question is, what is the best, most cost-effective way to purge longevity risk from your retirement picture? If that is indeed, I mean, survey after survey, Mark, has shown that the number one fear people have in retirement is outliving their money. So if you ask people, they will tell you, without maybe quantifying it or articulating it in precisely this way, they'll say that longevity risk is their primary concern in retirement, without even realizing that it is a risk amplifier, it is a risk magnifier, because the longer you live, the more likely you will have a long-term care event, the more likely you will succumb to inflation, the more likely you will, or the greater price you'll pay for taking an inordinately high withdrawal rate, or having sequence of return risk sort of turn your world upside down in retirement. So really the question is, how do you purge longevity risk from your retirement picture in the most cost-effective way? Well, we've talked about the 4% rule. It's literally the most expensive way to purge longevity risk from your retirement portfolio, because if you need $40,000 day one of retirement, you will need to have saved $1 million by day one of retirement. And so, Mark, you and I talk about there's more cost-effective ways. And, there's that four-letter word that Ken Fisher doesn't want you to hear about, and that's an annuity. Annuity is basically just a guaranteed stream of lifetime income that's guaranteed to last as long as you do. As long as you're on this side of the grass, you're going to have to keep receiving those checks and keep finding ways to try to spend the money. And so if you look at it, it's actually much more cost-effective to put money into an annuity and have the annuity generate that $40,000 than to save $1 million in the stock market. And so, unfortunately, annuities get a really bad rap because of the likes of Susie Orman, Dave Ramsey, and even Clark Howard, Ramit Sethi, Ken Fisher. But the issue is, hey, if it takes me $1 million to generate $40,000 of income under the Ken Fisher way, but I can generate that same amount of income for, say, $675,000, that's going to ebb and flow based on interest rates, but say $675,000 to generate that same $40,000 of income, and it's going to be guaranteed to last my entire life, then that frees up an extra $325,000 with which I can do some really interesting things. I get some long-term care, put it into my discretionary fund, take an extra trip around the world, take the kids to Disney World, what have you.
Yeah, I was having a conversation today. So we have one of our, somebody who joined our team last year is a certified financial planner, and he worked at Vanguard for 11 years. And they had some exposure to annuities, but not much. So that's one of his things that he's learning, and he's doing quite well. But we had a conversation just this morning about it, and he was, and we were just talking about the details of it. And the ones that annuities we tend to use have a level of principal protection or principal protection. And that's very, very important. But I would say that equally, if not more important, is the offset of that longevity risk, especially some of these platforms, the multiples that you get on your money, I don't know how you can do that on your own or in any other strategy, right? Because you get this either guaranteed growth rate or an inflated amount of growth rate every year, depending on the index return that you receive. So I'm trying to be very, very general here, but then when you start this withdrawal strategy, even if your portfolio draws down to very low or zero, which it would do probably in an ETF or a mutual fund, you continue to get these withdrawals. And even if you started at the same withdrawal rate, let's use the 4%, if you start at the same withdrawal rate, and then that portfolio drew down and you're still getting that $40,000 a year, and then it comes down to $40,000 and you're still getting that $40,000 a year, well, that's a pretty fantastic withdrawal rate. And then when it goes down to zero, you're still getting that $40,000 a year. Tell me where you can compete with that. And that was, I probably shared this with you and to other viewers in previous webinars, but there was a time when I was at Payne Weber and UBS, same company, they just merged or one bought out the other. I probably spent 5 years in my early time as a financial advisor railing against annuities because of all the things that I heard out there until I did my own research. And I learned at the time that, long story short, that the platforms that UBS were really pushing us to put people in, compared to annuities that were out there offering, that had zero guarantees, and the platforms UBS was pushing, and they cost about 1.5 point more than the annuities that were out there at the time. So it took away that argument of cost efficiency altogether, and that sparked me to do my own research, and that's what people should do, by the way. Just research things on their own and really compare these things. Just don't listen to people's platitudes and their own thoughts and feelings about things. Do your own research about it. There's plenty out there, and Dave's information is a good start. If you read Tax-Free Income for Life, or listen to it on Audible, whatever your method is, it really spells it out well. It's a really good resource. I give out Dave's all the time.
Yeah, Mark, you mentioned, imagine even if your balance went down to zero, you're still getting that $40,000 per year for the rest of your life. Well, what Tax-Free Income for Life does says, what if you could situate that annuity within the tax-free bucket within your Roth IRA? Now, all of a sudden, you're receiving guaranteed lifetime income that's shielded from the impact of higher taxes down the road. Mark, annuities are such a fraught concept. There's a lot of controversy around it. But I tell people all the time, I say, if you don't like annuities, you certainly aren't going to like Social Security or that company pension you're planning on receiving, because all of those work by the exact same principles as annuities. So all you're doing with an annuity is you're setting up a private pension that's guaranteed to last as long as you do. Yeah,
and you're right. I think the Roth is the place to be. And in my opinion, for a lot of people, again, take this as education, not advice. But but you do have to be careful. All annuities aren't built the same. Some are very, very, so you can go from 0 fee to 6% plus in annual fees. So you've got to be very, very careful on which one you're choosing. So another point you made was you said a lot of people don't take enough risk in retirement. So let's talk a little bit about that. What do you mean by that, Dave?
I mean, this is probably the one area that I agree with Dave Ramsey. I mean, I don't get me wrong. I love Dave Ramsey. I think that Dave Ramsey, if you're making 50 but spending 60, Dave Ramsey's going to do he's going to do a world of good for you. He's going to set you on the road to financial independence. But Dave Ramsey has long said that you should keep your money 100% invested in the stock market for your entire retirement. Why? Because the S&P 500 has historically returned between 11 and 12%. Bonds are erratic, they're volatile, you're going to get much lower amounts. In some years, you may even lose money. So why do bonds when you can just let it rip in the stock market, right? So that's obviously a pretty irresponsible approach, because it doesn't account for investor psychology in retirement, and people need their money to be there when they need it. And if the market takes a tumble because you're 100% invested in stocks in the first decade of retirement, I mean, I mean, the numbers on this are breathtaking. You
Yeah.
take an 8% withdrawal rate on 100% stocks, like Dave Ramsey recommends, you're going to run out of money, after 20 years, about 63% of the time. You're going to run out of money in advance of life expectancy. It's not even a coin flip, 2 out of 3 times. I agree with principle. I agree in principle with Dave Ramsey that you should be taking a lot of risk because you need your money to last a full 30 years. But I think that that the solution is not to eliminate a bond-like instrument. Okay, I think you could eliminate bonds in theory, and one way to do that is to simply reach into your portfolio, remove the bonds, replace it with an annuity, and that will actually increase your return. It'll lower your risk. It'll lower the standard deviation of your entire portfolio, and you'll experience a better outcome over time. And so the answer is not to eliminate bonds. The answer is to eliminate bonds so long as you replace it with something that does the work that bonds set out to do, but in a more efficient and effective way.
Yeah. 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 It's interesting because I often talk about when we look at historical returns, it's so misleading. And that's why, there's always disclaimers about historical returns, don't equal future returns. But it depends on your time in history, right? Because if your withdrawal, even if not necessarily losses, but if you look at 2000 and 2010, if you're just looking at the S&P 500, we had zero growth. That was the lost decade, right? Start to finish, it was a zero return. If you're drawing 4% a year, 8% a year, or 4% adjusted for inflation, you've got a loss every single year, and that's going to be escalated. Not to mention, it wasn't a straight line. So you're going to have monthly withdrawals or whatever your periodic withdrawals were, and some of them are going to be in very low positions that can never recover. So it really doesn't matter to you that the S&P 500 returned 12% a year since 1920 or whatever the number is. It depends on if you're retiring in 2025 and you're going to live another 30 years, what's the return of the S&P 500 going to be? We don't know. But there's going to be a lot of fluctuation there, and your average person can't withstand it. So it's just you definitely need a more robust strategy, and a simple way is exactly what you said: just eliminate the risk altogether of the bond portfolio. Because if you look in, was it 2022? I think we are now, right? So stock market was down about a little over 10%, and the bond market, depending on what bonds you're in, we're down anywhere from 8 to 11%. So you were down on both sides of that. And so just eliminating that risk has big advantages to folks. But again, we go a little much more in depth and make it very difficult for ourselves. Where most people have 5 different segments, multiple accounts, just set up to draw out specifically. But there's some core principles, and the first one is you've got to protect yourself against those deep down drawdowns. And we replicate the Great Recession in our financial planning strategies, and where you see 30+% drawdown. The market can drop 30% at any given time. We don't know. It could be tomorrow. We just don't know. So you have to be prepared for it.
Yeah, I mean, I've read an excellent book by Morgan Housel called The Psychology of Money. And he says, look, the premium you pay to get the type of return in the stock market is the ability to lose money at any time. He's like, you could pay $100 to go to Disney World and it could rain all day. Mm-hmm. Guess what? The upside is the fun that you have at Disney World. The downside is you could go and it could rain all day, right? So that's stock market investing for you. The upside is that you could earn 30% in a year, but the downside is that you could lose up to half of your money, like we did at a certain point in 2007, 2008. I mean, so the thing about the stock market is it's historically, if history serves as a model of past prologue, it's a permanent upward trend punctuated by, periodic downward turns, periodic bear markets. And that's why, we talk about my upcoming book. I got a whole chapter on explaining why I believe the stock market is the single greatest engine for wealth creation the world has ever seen. And I think that when we forego the stock market in retirement to continue to do the heavy lifting for us and generating wealth, we do it at our own peril. And so I'm a huge fan of taking a lot of risk in the stock market, so long as you have these other financial tools in place that give you a permission slip to take that type of risk.
Yeah. Yeah. And that's what, and going back to my conversation with our newest planner today, we talked about this happened to be a younger person, and we were talking about an annuity allocation. And he said, well, I know this person had wanted maybe to do some speculation and whatnot. And we typically carve out about a third of a portfolio to go into something that's principal protected. So, and I said, well, that's great. That gives him more ability to take those risks because he's got this, again, that foundation where if he's not gonna, if he invested on it all in something very, very speculative on his own, then and that loses altogether. He didn't lose it all, right? And I don't think he's going to do that, by the way. But it gives your average person, even if it's not this individual, the ability to reach a little bit more when their portfolio is protected. Because, like you said, you've taken away that downside risk when you plug that tool into your portfolio. It allows you to reach a little bit more for what you don't need today. Let's talk a little bit in the time that we have left about long-term care considerations. You touched on it a bit when you talked about longevity risk and how that compounds the problem of long-term care. But I do want to I want to spend some time about long-term care and some of the answers and some of the tools we have today to evaluate long-term care. And I don't know if you're familiar with the Water Lily tool that's available.
Sure am.
Yeah. So let's talk about that a little bit because we just started using that, and I'm very excited about it. It really helps pinpoint the risk for individuals. But tell me your
Yeah,
thoughts
I
on
mean,
long-term care.
you're teaching a retirement class, and if you were to walk up to the average 60-year-old couple that comes into your retirement class and say, what do you have four of, or what does every 60-year-old couple have four of? They'd say, arms, legs, eyes. And they say, no, you have got four parents. And what's the likelihood that one of those is going through a long-term care event? One of those parents is going through a long-term care event even as we speak. And so for a lot of people that are approaching retirement, they don't want to deal with long-term care in the same way that their parents dealt with long-term care. I mean, you look at even my own grandparents. How did they deal with long-term care? They sort of rotated between the children who were willing to put them up, over the course of the waning years of their lives, or they go to a Medicaid funded facility, which isn't always awesome. There's a lot of people saying, "Hey, look, I have the ability, I have the means to sort of mitigate the long term care risk, but what is the best, most effective, most cost effective way of going about doing so?" And one thing that we know is that historically, people are really averse to this idea of paying a long-term care premium that they hope they never have to use, where they pay it for 30 years, die peacefully in their sleep, hoping they never have to use it, and then they do die peacefully in their sleep, never having used it, and then they don't get any of that money back at the end. It goes to pay for someone else's long-term care. That can be a source of heartburn for a lot of different people. And so what a lot of people are doing this, and an article out of Wall Street Journal really bore this out. They said people are taking this hybrid approach where they use life insurance policies through carriers that allow you to receive your death benefit in advance of your death for the purpose of paying for long-term care. So let's say you got a death benefit of $400,000. You wake up one day, you can no longer feed yourself, bathe yourself, transfer yourself, what have you, any two of six activities of daily living. You can find one doctor to write one letter to that effect. They will start giving you your death benefit to the tune of 25% per year. So say like 100,000 per year every year for 4 years for the purpose of paying for long-term care. Now they may discount that number slightly based on the age in which you receive the benefit, but the point is they're willing to give you your death benefit while you're alive for the purpose of paying for long-term care. And that can be a much more heartburn-free approach to mitigating long-term care, because if you do die peacefully in your sleep 30 years from now, never had any need long-term care, someone's still getting a death benefit, probably your kids or your grandkids. So there isn't that sensation of having paid for something you hope you never have to use. And so it's a huge issue. You can really burn through a lifetime's worth of savings in just a couple of years if you don't have a plan in place to safeguard against it.
Yeah. Yeah, and I have so many stories. I used to work with an elder law attorney who did some Medicaid planning, or does quite a bit of Medicaid planning, and he convinced me to help him with these Medicaid compliant annuities. Now, these are structures that are designed just for funding care and transferring assets away from the ownership of a person so that they could qualify for Medicaid. But There's one that always sticks in my head, and I talk about in class all the time. Is I had a woman come in. Her parents were accountants. They saved well. They had over $1 million in savings. They had a house up here in Pennsylvania outside of Philadelphia and one in Naples, Florida. And when it all came down to it, she was trying to save the last $35,000 that they had. So it can really eat away at all your life savings. And everybody says they don't want to be a burden to their children, and it's a real consideration. And one of the things that I really like about this new tool that we have is an AI-based tool. I really like, I don't think AI is the end all be all again, but I think we have to pay attention to using them as tools. And one of them is we have a common group of colleagues in the financial independence group, and they brought to us this tool called Water Lily. So it was put together by two really bright young individuals, and using the technology we have today, instead of just telling someone, well, if you're over 65, a married couple over 65, you've got a 70% chance that you're going to need long-term care. Most people think they're going to be in the 30%, right? They say, oh, well, that's a shame for the 70% other people. But what this new technology allows us to do is look at your family history, look at your situation, take in all these thousands of data points, and give you a probability that you're going to need long-term care, when that might be and how much that might cost. So that gets very, very personal. And we found that it's a much different conversation, because now, instead of saying, well, geez, I'm going to be in the 30, not the 70, you can look at it and say, I better pay attention to this, because my probability is 90 or high 80s, and this is when it's likely to happen. And I think that's pretty fantastic. I hope it doesn't happen for anybody. But to your point, when you use something like cash value life insurance to fund long-term care, well, geez, if you're lucky enough that you don't need that long-term care, it passes to whomever you choose to pass it on to. It doesn't stay with the insurance company. And our friend Ed Slott says there's nothing more tax efficient than life insurance.
He says the single greatest tax benefit in the IRS tax code is the tax-free benefit for cash value life insurance. That's a pretty big statement from someone who USA Today called America's IRA expert. For him to make a statement like that, saying the single greatest tax benefit in the IRS tax code is cash value life insurance. I mean, that's not something you say. That's not just an off-the-cuff remark. It's a thoughtful, premeditated remark, and he talks about it in his books and at the conferences I've seen him give. But it's something I echo in my books as well.
Yeah, yeah. It can be powerful. It's not for everybody, because unfortunately, anybody can open up a Roth IRA, but you've got to go through an underwriting process. So you have to make sure that it's not too costly. Because definitely life insurance isn't necessarily a low cost option, but it can be beneficial in the right circumstances. So it's certainly something that you should consider. In fact, we've adopted, and this goes back some time, when we make a recommendation for someone to use life insurance or even an annuity, and they opt not to, we have them sign a document that we keep in their file that says, we presented it to you. We don't, and we're choosing not to go forward with it. We shared the pros and cons, and we'll even attach the illustration we used. And because people are forgetful, and they'll come back and they say, why didn't you consider this? And actually, there's been lawsuits against financial advisors saying, why didn't you consider this for my family? And I know that was one of the things you talk about with Ken Fisher, is how, as a fiduciary, can he completely discount a significant, powerful tool for people like annuities and like life insurance, just for a marketing ploy, because that's what it really is. He's a brilliant marketer.
I like to remind people that the subtitle of my book, The Guru Gap, is how America's financial gurus are leading you astray and how to get back on track. And people think that just because people have critical mass, they have huge followings and loud voices on the internet, that what they're saying by definition is true.
Yeah.
That the trueness of their statements or their worldview is directly proportionate to the size of their following. That's and in many cases, it's actually the inverse. Because the larger you're following, the more you have to sort of paint everything in one size fits all, paint by the number approaches, which by definition is going to apply to very, very few people. And so, as you've stated over and over on your channel, you need customized, tailored, individual advice, and there's no cookie cutter approach when it comes to this type of stuff.
No, I wish we could help everybody. And I'm always proud. I always say if you get, I hope people coming away from class or webinars, if you can't, if it doesn't work out for you to become a client, if you don't qualify or whatever the situation may be, I hope you at least get something out of it, and you move yourself forward a little bit. But I love it that I guess, Dave, when you and I connected, there were probably maybe 100 or less than 100 people in the Power Zero group, right? So this goes back to 2016. So where are you at now? Like how many advisors are affiliated with the Power Zero group?
We always
how many
have,
advisors do you have?
yeah, we always have new advisors coming in. I think we're closing in on 300. We're definitely well past 275, so we're closing in on 300. And so there's Power Zero advisors in every state, all across the country, except for maybe Alaska and Hawaii. But all the contiguous states, we have representation. So and we're very well represented in Pennsylvania. I'll tell you that right now.
Well, I appreciate that. I think you're talking about me. So
Yes, indeed, I am.
yeah, so that's a great group, and for everybody who doesn't know, I get emails from Dave all the time about let's get on the Zoom call, talk about tax law updates. Let's talk about other programs. So he has a mastermind group, and just like Ed Slott's group, the people on this channel are just tired to hearing me talk about the Ed Slott Lead Advisor group. But your group is right up there with them, and it's we'll be together in Tampa, Florida, and we'll be talking about updates and things that are going on in the tax code. There'll be a lot of information about the OBBBA. I'm sure with the updates with the Ed Slott group. So I appreciate the work that you do. I appreciate everything you bring to us to keep us current. Folks, just so you know, there have been times for sure when I'll be sitting with a situation with a client, and I'll reach out to Dave and say, hey, what do you think? And nobody responds faster than David McKnight. It can be a Sunday. I send him emails on a Sunday evening, teeing up for a Monday morning, and I surprisingly get a response, thoughtful response. So I appreciate that.
Is my wife going to be watching this video? I don't know if she knows that I'm as available as you say I am.
All right. So Dave, what is new at Power Zero?
Really with Power Zero, we're just preparing our advisors to shepherd their clients through the OBBBA changes, the One Big Beautiful Bill Act changes, which people are seeing and hearing different things on the media in terms of what the implications are for Social Security and Roth conversions. And people are now saying you should no longer consider a Roth conversion for the next 4 years because you're going to get this extra senior bonus deduction through 2028, and therefore you should not consider doing a Roth conversion. I'm really beating the drum loudly over this idea that there is no such thing as a permanent extension of tax cuts, that this is a temporary permanent tax cut. And for all intents and purposes, there comes a point in time beyond which the federal government can no longer procrastinate raising taxes, and that's 2035. And so if you push your tax-free, get to the 0% tax bracket plan off until 2029, you then have that much fewer, that many fewer years to be able to get your fiscal house in order before tax rates go up for good. And so really just helping our advisors navigate the new tax law and how it applies specifically to their clients.
Yeah, that's great work. And now you got a new book that you're working on or scheduled to come out. So you want to talk about that a little bit?
Yeah, so this book is aimed directly at millennials and Gen Zers. Okay, so these are people anywhere from, what is that? Basically 20 through 45, something like that. Mm-hmm. I don't have the exact ages down, but that segment. So basically, my kids, your kids, and then people maybe one generation above. So really, in all my research into these two generations, what I found is that compared to their Gen X and baby boomer forebears at the same age, they have less investment knowledge, and they're they're less prepared from a retirement planning perspective than their forebears. And so I wanted to write a book that addressed directly these two generations. But I didn't want to do it in a business book, a boring old business book format. I wanted to write a financial parable because I think that if these younger generations are going to pick up a book, they're not going to pick it up unless they think they can finish it. So it's a pretty brief book. It's about 140 pages. It's a financial parable. It's about a kid who's a social media star named Caleb Calloway, and he's got millions of followers on YouTube, and he's basically into Bitcoin and NFT and moonshots and all these different types of exotic investment investment approaches. And he thinks that that's the future of investing. He thinks that stock market investing is old and antiquated and stodgy, and so he wants to usher in this new era of exotic futuristic investing. And he to be able to land a job at this coveted investment firm where he can sort of execute all of his strategies on a much larger scale, he has to graduate with honors, which means he's got to pass his dissertation. And when he goes to defend his thesis, which is based upon his exotic principles, the professors absolutely shellac him. They say, you have no data to support this. You've got 6 months worth of data. This is not going to replace you do not pass your defense. And so they say, we'll give you a week to recalibrate everything. And so he finds a janitor who warned him that this would happen. And the janitor introduces him to a group of everyday investors that, by applying 7 basic principles to their lives over a long period of time, all became multimillionaires. He has to go interview one of those people per day for the next 7 days to formulate a new thesis that will pass muster with his professors. Anyway, it's a really cool. I tell people it's sort of like Dan Brown and M. Night Shyamalan got together and had a love baby. It's got some cool stuff in it. It's got a twist ending that you will not see coming. It's got a Dan Brown, Dan Brown element to it. And if you like Power of Zero type planning principles, that's woven all through it. So it's going to be a really cool book that you can hand out to the younger generation. And so I'm excited for that to come. It comes out not till May of 2026. That's how these big publishers work. They can get they need like a year worth of ramp up. So the book is done, but it's not going to publish till 2026.
Okay. Well, I look forward to it. Well, one of the best parables is the richest man in Babylon, right? So that's one of my favorites. I remember reading that when I was a young guy. And did you ever hear of a book called The Algebra of Wealth? Scott Galloway.
I've heard of Scott Galloway. I've not read that book.
So it might be an interesting read for you. I'm listening to. I'm in the middle of it right now, listening to it. And after the first couple of chapters, I actually sent a copy to my daughter's boyfriend because he's in business school at Penn State, and it has a lot of great information about choosing a career and really how to set yourself up for success in that career and where your time should be devoted. And I thought it was really great. So it might be an interesting read for you if you listen to it on Audible. It's not too, it's a few hundred pages. It's not too bad.
The Algebra of Wealth.
The Algebra of Wealth.
Yeah. Okay.
Scott Galloway. Yeah, it's a good book. All right, Dave. As always, this was excellent. I appreciate the time. Anything else you want to close with?
No, I think we covered a lot of great topics, and as always, I appreciate you having me on. You're doing great work over there in Attleboro. I got the town right, didn't I?
No, that's the name of my firm. But it has nothing just to keep things confusing. It has nothing to do with the town. So the town is Newtown.
That's right, Newtown.
Yardley and Newtown, Pennsylvania.
That's right. I've only been to your office 2 or 3 times by now, so I should remember what the town actually is. I presented with Ed Slott in Newtown, so I should remember it.
The first time ever on stage, David McKnight and Ed Slott was in Newtown, Pennsylvania together.
Right. Shared the same stage, first time ever.
Chicago, Illinois.
That's right.
It was.
That's right. As was previously built. Yeah, that's right. You came in and you stole the thunder right then and there. So that was awesome.
That's right. All right, Dave. This was excellent. Thank you so much, and we'll talk soon.
All right. Thank you, Mark.